Heavy machinery laying massive underground pipelines across India. That's the core business of Technocraft Ventures, gearing up for their August 2026 IPO. The company is looking to raise a total issue size of 251.88 crore rupees, offering shares in a price band of 200 to 212 rupees. For retail investors, the entry ticket is a minimum investment of exactly 14,000 rupees, which secures a single lot of 70 shares. This chart shows revenue trajectory in the bars, while the trend line tracks profit after tax, climbing from 19 crore in 2024 to 43.3 crore in 2026. These growth figures pair with eye-catching fundamentals, a 26.51% return on equity and an earnings per share of 24.39. However, those numbers are tied to a specific set of operational challenges. Technocraft sits on an unexecuted order book of over 1,300 crore rupees, built on the EPC model, engineering, procurement, and construction. EPC businesses require massive upfront spending to start projects, followed by waiting on historically slow-paying government agencies to settle the invoices. We are going to map out the exact financial realities of this EPC model and match them against specific investor profiles to see if this IPO fits your portfolio strategy. Healthy profit margins mean very little if an investor is uncomfortable with the liquidity lockups inherent in chasing government payments. Technocraft's current growth is driven by an unexecuted order book of 1,305.45 crore rupees, recently bolstered by a 196.47 crore water project in Delhi under AMRUT 2.0. This backlog provides a highly visible 2 to 3 year runway for top-line revenue growth. This map illustrates the concentration risk within that pipeline. Most projects are grouped into heavy clusters across northern and central India, specifically Uttar Pradesh, Rajasthan, and Delhi. These projects are almost entirely controlled by state governments, public works departments, and urban local bodies. A state-level political shift or a local budget freeze in any of these areas could immediately halt a major portion of Technocraft's revenue. While the company is expanding into Madhya Pradesh, Bihar, and Odisha, the core revenue remains linked to a few specific jurisdictions. Investing here is a direct bet on the continued infrastructure budgets and bureaucratic efficiency of a handful of North Indian state governments. This dependence on the government explains why Technocraft is raising 150 crore rupees from the public, specifically for working capital requirements. In the EPC model, the contractor pays upfront for materials and labor, executes the project, and waits for bureaucratic approval before a government payout. The bottleneck occurs at the end. Delays between project completion and the actual payout can stall cash flow for months. Despite these cash demands, the company has maintained a debt-to-equity ratio of 0.55, suggesting they aren't currently overextended on loans. The 150 crore rupee injection from the IPO allows them to take on larger contracts while maintaining their current debt-to-equity balance. While these funds address immediate liquidity needs, the long-term reality is that this business model requires constant access to operating cash. Technocraft manages these projects with an in-house team of 78 engineering professionals and holds Class A electrical licenses for high-tension infrastructure work. Managing Director Sanjay Tyagi leads the company with over 35 years of infrastructure experience, including more than 15 years spent inside the Ghaziabad Development Authority. This expertise has helped the company maintain a 12.56% PAT margin and a 27.72% return on capital employed, supporting the bull case for the IPO. However, external risks can impact these margins. Since many contracts are fixed price, spikes in the cost of steel or cement must be absorbed by the company. Technical risks are also a factor. Complex tasks like trenchless microtunneling are subject to geological delays that can erode the profitability of a project. These margins are vulnerable to unexpected macroeconomic shifts or engineering miscalculations during project execution. Technocraft Ventures is a profitable, well-managed company whose success is currently linked to government efficiency. We can use this scenario match framework to determine who should deploy the 14,000 rupee minimum investment. For a growth investor, the 26.5% ROE and huge backlog make this an attractive candidate for long-term compounding. The trade-off for this growth is the need to monitor state budgets and regional political shifts over the next 3 to 5 years. Momentum traders may find listing gains due to the small issue size of 251 crore, though volatility in infrastructure stocks is often high. A cautious retail investor may find the working capital requirements and government payment cycles too risky for a low volatility portfolio. Skipping this IPO means missing out on a company doubling its profits during a period of high national infrastructure spending. If you plan to apply, check your UPI limits and mark the calendar for the August 7th open and August 11th close. If you aren't allotted shares, your funds will be automatically unblocked on August 12th. Evaluate this IPO by looking past the prospectus and deciding if these specific operational trade-offs align with your own risk strategy.